my name is Thierry Baujard, and I'm the CEO of a company called Media Deals, based in Berlin, which is an European investment network for creative industries. We have created this network in 2008 and working with different investors across Europe to get them to invest in, let's say, creative industry in the broader term. So our interest is to educate the market, especially the investors, to understand why creative industries is an interesting sector, why is it growing, and how to invest in it, and at the same time to get startups to be ready for investment, to help them to understand how investors are thinking, what's the business model of an investor. But there are different types of investors, and really understanding what's their business model. Once you understand how they make money and why they want to invest, I think it's much easier for startups to look for money. So that's what we do, basically. Okay, I think if the number of co-founders is not too high, meaning if it's a couple of people, or let's say 3 people maximum, I think it's good and it's more interesting than just one person, because obviously if this person happens something to this person, that's going to be a problem. And also if you have different people who could be complementary, I think it's a good plus for investors. But if you are more than, let's say, 3 or 4, I mean, of course there are exceptions, but I've seen companies with 6, 7, 8 co-founders. That could be really a problem, because investors could think that it's going to be difficult to get agreement from everybody for everything at the same time. For a pitch deck, I think it's very important to show who's the team, who are the people behind it, what they've done, and what's the problem you're trying to solve with your project, with your company, with your service. So really understanding what is the main problem, the pain, what we call, and then what is the solution that you're bringing. Okay, these are the 2 important points. After that comes, let's say, the market size. What is the market size that you are aiming at to get to? That's also very important. And then the business model, I would say, to understand, what sort of model do you have in mind? Is it a license, a SaaS, a commission model? I mean, what is the business model behind it? So to explain a little bit the business model. And then you can put some financials to give an idea of what you want to go. But the reality is that the financial is just an indication, because people will be interested to develop that further once they understand your business model. So that's not too important to go too much into details with financials in the pitch deck, I would say. Between the presentation deck and the pitch deck, I mean, a presentation is, of course, what you present to people. So normally it's a pitch of, let's say, between 3 and 7 or 10 minutes. So something that is quite lively, what you present and you explain what you do, etc. The pitch deck is a piece of paper. We tend to say that it's better to keep it very short, like 2 pages maximum, so that people can get an overview. And the idea with a presentation is to start a conversation, a dialogue with the investors. The pitch deck is more to make sure that you can be invited for a presentation, for example. So that's the difference. So the content in itself is very similar between the 2. The presentation is more like, as I say, more lively, I would say, and more with pictures, etc. The pitch deck should be, I think, more compact and present really more text and what you want to achieve. But the content should be also very important, should be coherent between the two documents. You can't say in the presentation that you want to do that and the pitch to do something different, or to have different numbers, for example. They have to be very coherent. Okay. Yes, I mean, there is a difference between the hardware and the software. Yes, to develop a hardware product will take much more time. You will need prototypes, etc., which is a little bit the case in software, but maybe the cycles are a bit shorter. You have a beta version, alpha version, etc. You have different steps where when the product is developed. So it's a bit similar, even though, of course, with hardware, until it's ready and for mass production, it can take much longer time. But the key problem that you start with something new on the market and that you don't have any data or sales history is the same for software and hardware, I would say. And of course, it's a problem that most startups have. I would say the best is really to do comparables, to do work with comparables, to take different comparables, to say, okay, for example, this hardware is similar to this hardware or this hardware, and show what are the sales forecasts that have been developed and done by the different company for this piece of hardware. So that's really the best way. You have to take different types of hardware because you will not, of course, find something that is exactly the same as yours. Otherwise, it's too much competition. But taking different types of hardware or software that have similar features or similar access to similar markets or similar price entries. I mean, you have to take it from different angles so that at the end you can start having a better idea about what could be sold. What is important is not to take too big success because, of course, if you take a very successful product and you say, okay, I compare to this product, of course, it's really an exception, and you start to compare with something that was an exception, and it's difficult for an investor to understand that. They say, okay, yes, I understand this is what you want to do, and that's maybe the best scenario, but the reality is that your product will be more similar to a normal product, and then the way you work on it and you develop it could make it as a success. But be careful not to take too many successful comparables, because otherwise, the results will be very biased. Because one important thing for investors is really to understand the risks and to understand the reality. We know the product is not perfect. We know that it's going to need some improvement and some money to develop. And if you take something that is very successful, everybody knows that it's not going to be a reality. It could be at a later stage reality, but at the beginning, it's not like that. Okay. Yes, that's a good question. I think, of course, investors expect 5 times or 20 times or 100 times return on the early stage company. But of course, they are not expecting that in the next 18 months or 2 years or 3 years. They expect this kind of return when they exit, which will be much later. I mean, we're talking about 7, 8, 10 years, and where other types of investors will come on board and bring added value about that. So, of course, at the beginning, you cannot, when you talk to investors, I mean, they will tell you that, of course, that's what they're looking for, this kind of return. But as I say, in the long term, not straight away. I mean, someone who invests 100,000 euro, for example, in a startup, can't expect to have that to get that 5 times in 18 months in the development of your startup. No, he will say, okay, he will take the share, there will be other people, there will be other rounds of financing, and then at some point when the value will increase a lot from the startup, when they sell to someone else or they do an IPO, they want to get this kind of return. So first, that's a problem of timing. This type of returns, which people will say to you, because of course that's what they want, it's not for now, it's for later. So you need to tell them that, you need to explain to them that, of course, after different runs and the development of your company, that's the kind of return they can expect for the sales. The second point in the question is, of course, about the niche market. Is it possible to get this kind of return in a niche market? Of course. It depends really how big is the niche market, of course, and also how can you develop the product from a niche market at the beginning and then expanding to other sectors. We've seen many products, many services who started on a very niche market and then has been accepted or bought by a very large amount of people. So of course you start in a niche market, and I think that's important, but that's really the first step, or the first 2 or 3 steps. And again, through a new round of investment, maybe you can open to other market and not stay just a niche market per se, but something much broader. Okay, but I think the idea to start on a niche market is quite important, especially in this industry. I don't think all startups should or have to take equity investment. I mean, of course, equity investment is making things faster, is helping to get what we call smart money, so not just money, but also services, added value, expertise from the investors to go quicker. But there are other ways to finance a startup. You can get, of course, clients, you can get debt financing, even though, of course, it's difficult as a startup. You can do a mix, an hybrid with a little bit of equity money to leverage some debt financing towards the bank. That's also possible. You can use other things like crowdfunding to develop a project as well. So, first point, I think, is that you don't have to think right from the beginning, okay, I need to raise equity. I think you need to come to a point where you say, okay, now to get it faster, I've done all of the other financial sources. Now I need equity financing to go faster and to reach what I'm trying to do. So that's really a point. So it comes exactly to the second part of the question, is when is the right time? I would say the right time is really the latest, but where you can wait. If you do it too early, of course, through the dilution, etc., you're going to lose a lot at the beginning, and also at the beginning, the valuation of your company will be very low, very low, because you don't have much. So whatever the people will invest, they will take always too much. Okay. So that's very important. I mean, for example, accelerator take 5%. I mean, it's quite usual to take 5% right from the beginning, and they give you, I don't know, 20 or 50 or 100,000 euro. You have to do the calculation, but sometimes it's much less than real 5% of your company. So you really have to think when is the right time. As I say, should wait. So that means you should really follow the typical investment sequence, in the investment cycle. So meaning talking first to maybe your friends and family, people who could put a little bit of money into that. Also very important, understanding that these people could maybe sell easily their shares quite early, because you don't want to have too many investors at the beginning. What we call the cap table, so the shareholders should be quite small and quite clean. So if you have, I don't know, if you have 10 people from your family, for example, at the beginning who put a little bit of money, I think that's something that is difficult. It's better that they invest through, for example, one person instead of 10, or to make sure that they will agree to sell these shares to a certain price, for example, that you could buy or that a new investor could buy at a certain point to make the cap table quite clean and not too big. Okay, so that's very important. So first, family and friend. Second, yes, public money that doesn't take an equity, but will finance your startup. Then maybe an accelerator, and then at some point when you've got your pilot, MVP, you're going quite far. You've done maybe a pilot project where you see the response, so you can start having higher valuation of your company. That's maybe a better time to start having rounds of financing. So that's what I also think, is that you shouldn't ask for too much money at the beginning, even though you have that in mind. So you say, okay, we want to raise, I don't know, 1 or 2 million euro, but you want to raise it in small amounts. So 200,000, 500,000, and then a second round, a bit higher, etc., to come to 2 million. Okay, so that you can, through that, you can see how the value from your company will increase. You can also check how the investors are. Are they helping you? Is it really smart money that they are bringing, or just money and they want their money back? So you don't have to commit to a big amount right from the beginning. So yes, it's very important to find the right time. Yes, as late as possible is better, definitely. And when you really think, okay, you need now a big financial push to get quicker and to achieve quicker what you want to get in your business plan. I said in the last one, you have to find the balance. I mean, I think it's very important to be ambitious. So that means to show to investors, first to explain to them that you will need more money and that you will need money to be very ambitious. So, don't say, yeah, I'm looking for 500,000 and yes, I don't need any more money. Nobody will believe that. You have to say, okay, we will need 2 million euro, but we have different milestones, KPI, where at some point we will need 500 and then 200 more, etc. But they have to understand the ambition. So in the business plan, you have to show that, but also based on the clients you're going to get, the revenues you're going to get, this amount could change. Okay. So it's better to raise what you said step by step. Maybe not the minimum required, because it always takes more time to raise money, and also you always need more money than you think. So I would say to do it step by step, not maybe the minimum, but a bit more every time. And also to have longer cycles, so not 3 months or 6 month cycle, because it takes roughly 3 to 6 months again to raise again more money. So if you find money just for 3 months, as soon as you've got the money, you have to start for the second round. So I think it's difficult. So like 9 months to 1 year money for that, I think it's important. And then starting after 6 or 9 months, to 6 months, for example, for 9 months, to say, okay, now we've achieved this kind of thing, and now we can go to the next step. But all that is true. You need to do it step by step. You need to be ambitious, and you need to have customers and references. So all that is valid, but you have to show everything together. That you're very ambitious and you need a lot of more money than you think, step by step. So not everything in one go. And as long as long you get customers, maybe this amount will reduce, or there will be a different approach to the money raising. So, in terms of evaluating your company in this kind of market, is really about looking at forecasts, of course, looking at what they do, looking at doing some pilot project to show that it's growing and that people could be important. And then the best way to do it is really to identify investors or financiers who have been already investing, who understand that, believes in the future of that, and these people will be more open to talk to you and to invest in your company. So that sounds, of course, very logical, but it's a lot of work basically to search for projects that have been invested in the last years, and really go through all the investors and understand, okay, these ones are the ones who could be more interested. If you talk to many investors, in any way, all types of investors, of course, most of them will not have any experience. You will have a lot of negative answers, obviously, and that will be very depressing for you, very difficult, and also it will be normal, because you can't get people who don't know a sector to invest in this sector. I mean, it's like, for example, I don't understand the insurance sector. Even if someone says to me, this sector will be growing and look the numbers, I will always say, well, I don't know the sector, so I will not invest in this sector because I don't know enough. Okay, so it's always the same. It's really talking really to the people who have some kind of understanding and will understand the market and will support you in that field. So in that case, you need to really have a strong search in this area for this expertise, and then I'm sure you will have first some very strong feedback. So because they have expertise, so they may say to you, it could be interesting for us, but for some reason we cannot invest. We don't have money at the moment. We have invested in something similar or something competitive, or we don't think it's the right time for that. So that's also very strong feedback for you. And then they may say to you, okay, I can't invest now, but come back to me when you've done that and that, and I will relook at the project again. So it's always better to talk to the people who understand the sector. I mean, we've talked about it a little bit before in terms of finding family and friends money. It's quite important to do that, in fact, because it's good to show that people who know you, who trust you, they will invest in your company. If they don't invest at all in your company, I think it's going to be difficult to get outside investors to invest as well. I mean, it's not a must, but I think it's quite a good sign to say, okay, my family or some friends have invested in the company. As I said before, it's also very important not to have too many of these friends, or to put them under through one person or one company, to make the cap table as simple as possible, as I said. But it's quite important to do that. Crowdfunding is also another way to get this kind of money before seed investment. So that could be another way, but it's a lot of work, in terms of marketing to access this money. And it's not at the end really a strong investment, to be honest. It's more like community building, getting some feedbacks from the market, etc. So that's also interesting to do that, definitely. So these are the two ways. And how to find it? You need a small business plan, you need to show a prototype, and you need to explain to the people why it could be interesting. And of course, it would be important to explain to them what's going to be for them to get back from it. So first, it could be a good way for them to be part of a startup and to understand how it works to develop a new product. And the second thing is, of course, as I said, at some point, they will exit their investment. That means if they invest, I don't know, €1,000, at some point, as I say, other investor will buy that with an extra value, because the company will gain value. So maybe instead of €1,000, they will buy 5,500, or something like that. So that's something very quite interesting for them, even though, of course, I don't think they should invest to get back their money, or to make some return, but more to help you. But they can get some return. If you manage to do financial rounds, they will get back their money plus hopefully something on top. The team, again, I mean, that's very, very important. So who you are, I mean, of course, they know you, so they need to understand why you are so important, and that nobody else or not many other people could do what you're trying to do today. So that's part of it. The solution you're trying to bring to this problem, to this pain that we talked about, is also important. And maybe the timing, as I explained. How long do you need this money for, and what's going to be the next step? If you say to them, okay, invest in my company, and then we will see when we will get money, and then you will get your money back, that's not interesting. I think if you say to them, okay, our plan is to give us the money, we do a crowdfunding, we get some public money, and then we want to do our first round, in 12 months. Okay, you can tell them, okay, in 12 months, you could have a way to exit the company, or to sell your shares. So that could be also important for them for evaluating this investment. To evaluate the company itself, as I say, apart from the people, it's really the service, and what could other investors could be ready to pay after 12 months. So to have a test to investors, even though it could be a bit difficult, but the test, for example, for crowdfunding, how many people are pre-buying the service, for example, that could be a good way for them to evaluate the service. But of course, at this early stage, it's very difficult, very limited what you can really evaluate in your company. Yeah, that's a good question. I'm trying to understand whether it's different from other sectors. I think definitely the team is very important, because again, if you give money to someone, you want to be sure that this person, you can trust this person, of course, but also you will be able to face potential problems, because there will be some problems. Will be able to raise more money. That's a very important point, because as we talked before, the money raising is every 9 months happening, and is this person able to do that? And the next point, of course, is whether these people can deliver what they say. Writing a business plan and explaining, okay, we're going to do that and that and that is very nice. The question is, are these people really able to do it? Can they really do it? Do they have experience? Are they going to work, 24 hours to make it work? Are they going to really get, a skin in the game, as we said, so to really be part of a project and really, or it's just an idea, a nice idea, and if it doesn't work after 6 months, well, we'll do something else. So it's a lot. So we do a lot of work in creative industries, which also is attached to technology a lot. And very often people, mix between a real startups with potential and a lifestyle company. A lifestyle company is typical a company where you can make some money, you develop a project, a creative project, and business project as well. But your intention is not to make it very big. Your intention is to keep it manageable, to live well with it, to have, 10, 15, 20 people, etc. And to achieve what you have in mind. But it's not what investors are looking for. Investors are looking for scalability, are looking for ambitious people who wants to target something quite big. It doesn't have to be, Microsoft or the biggest company in the world, but they want to see people who really want to go through this journey find other sources of financing, do this exit, this sell. That's a very important point. For example, are you in fashion tech? Are most of the people ready to go for exit, meaning to give up a part of their company to someone else? What does it mean? Are they ready to do it? When are they ready to do it? Very soon, later, to everybody, or to a certain kind of people? So this is all very important. So it has a lot to do with the person. And as you know, you can't get the people to know straight away. You need time. So you need to, and many investors do that. They invest in small amount to see how the company is progressing, but to see how the people are reacting to problems, to changes, to change of market, to change of business plan. I'm sure we're going to change the business model many times with investors. How do people react to that? Are they going to say, oh yes, it's interesting and I like and I want to change and make it work? Or they say, oh no, that's what I wanted to do that and I want to stick to that and I don't want to do anything else. So these are all the things that you need to understand in order to say, okay, it's interesting to invest in this company. So you see, it has not much to do with the sector in a way. The question of the sector, I think, comes in a second step. Once you found the right people, you see the right ambition and the right way to address the business model thing, because I say it's going to change. And then the second thing is, okay, do I know the fashion tech sector? Do I think it's a sector that is interesting in the future? Do I know enough? Do I want to invest in this sector? Is it a sector that is strategic for me because I really want to go into that? Or is it a sector that is more for diversification? So that means I'm investing just in tech, and okay, I've got a couple of investment I want to do it a different way, to try other things. So it depends really on that. But the sector is coming really as a second step. But it's a second part, but it's very important. If you like the people, if you trust the people, but then you don't know the sector, you don't invest. Okay, but if you know the sector and then you don't trust the people, you don't invest either. So you need both. Okay, but the first thing is really the team. Well, I think the main point, as I say, is in terms of investment and financing, is really to think about what's the best way to finance your project, and not necessarily think you need just equity and directly just finding investors. I think it's really thinking about what are the different ways of financing. For bank, for crowdfunding, for family and friends, for which type of investors. There are many types of investors. There are business angels, there are seed capital investors, there are venture capital companies. So really to think about that, because we talked about it during the interview. It's really about focusing and finding the right people for you. It doesn't break anything. It's even worse to talk to everybody and to say, okay, who wants to invest in my company? That's not the way it works. People will not invest in your company just because you go to them and say, invest in my company. You need to really focus on what are the financiers you're looking for, who are they, why are they, what are they invested in the past, what is their interest, and then really respond to that. So it's better to talk to, 5, 10 investors, but really targeted and really people who are interested in you, than sending information to 100 investors. That will not bring anything. And also it will bring very disappointing response to you, and you will say, okay, nobody's interested. It's not true. Investors need your business, because that's their business model. Again, this is very important to understand. If they don't invest in your company, they don't make money. Okay, But they have to, they will invest in your company only if it fits their criteria. And as I say, the team is important, and the expertise in the sectors, understanding the business model is very important for them. So if you can really understand what sort of financier you're looking for, what's their interest, and then really develop your pitch deck, presentation pitch, to explain exactly that to these people, not to the rest of the world, nobody cares, to these people, you will be successful. It works. People are interested. Or at least they will tell you, okay, I can't invest because of that, and you can understand and change it. Or maybe you say, okay, there's no place for that on the market, but okay, you don't waste any more time. You do something else, basically. But the worst is to talk to many people, not having some progress, just having negative and thinking, okay, I have to call again 100 people. That doesn't bring anything. Really keep being very targeted, focused, and understanding what you're looking for and what sort of criteria they have, and answer to that. There are different ways of doing that. It depends, at which stage you are, what you're looking for. A very good way to do it is to start with EBAN, which is EBAN, which is the European Business Angel Network in Brussels. If you go to their website, you can show it's open to everybody. You can see all the list and all the different business angel groups in Europe, in the different countries, etc. So it's very easy to access that, and then you can also talk to the Secretary General there at the EBAN in Brussels to explain, okay, I'm based there and there. I'm interested to get to know investors. Can you recommend me some ideas about that? So that's a good way. Second thing is really to look at comparable startups who raise money. Look at the people you think they have done well, you think their product is good, and they've got some, they've got some good setup and development. Who invested in this company? These are the most important thing. If you find out, 2 or 3 VCs invested in this company, you should contact them, because you think that they invested well and they made something good. So that's very important. You could also go to the startup who got the investment and ask them, talk to them about what they think about the investors, and what they think about your startup. Is it the right time? Is it the right way to do it? And maybe they can do recommendation to you, to investors. Investors really like recommendation because they receive so many applications from everywhere. They don't know where to start, and they don't know what to think about most of the time. So if someone that they invested in, that they trust, said, okay, I know this guy, I've met this guy, and it's very interesting, and you should look at this project, that's the best. That's really the best. So you can do that. These are the best way. I mean, in terms of conferences, I mean, if you go to different fashion tech conferences who you have investors, or now online, of course, you can get to information. I think it's, again, before talking to people, before pitching, it's better to really do some research, find out who is doing what, and then once you know that you fit into what they are looking for, you should talk to them, but not just like that. Okay, talking to everyone, as I say, that's not very efficient, because even if you pitch and they could be interested, maybe your first pitch will not be perfect, or you're not completely ready, and then people say, okay, come back when you're ready, but it's already something you've done with them, and there will be already some kind of history, and it's better to have to start on the good point. So it's important to do that. Just maybe one last point about that between the US and Europe, because in US you have a lot of marketing about investment, etc. The markets are very different in terms of investment. In Europe, people tend to invest very locally. So the Germans will invest in Germany, but also just in the region. Italians the same. I mean, everybody's very local, except maybe the Nordics. And now for Great Britain is a bit different. They used to be much more international, but I think today they are still investing internationally, I would say, but I think maybe less than in the past. But the Nordics are quite international. So think a lot local. And in any case, that's also always what I say is if you think you need an international investor, which is a good idea, it's going to be very difficult to get if you don't have a local investor already on board. So you should start with a local investor, trying to find someone who is interested and invest a little bit. Once you've got that, it's easier to get the international investment. But to start with international investment would be much more difficult. Or do it at the same time, but to find just international investor it's very difficult. And then in the US, the difference is that they invest much more, but also with valuation much higher than in Europe. So it's difficult to compare. So when I was talking about comparables before, I think you should really compare what is comparable. It's always the same. Compare with European project if you have something European. Compare with the US if you have something American. Okay, but it's very different approach in terms of investment and financing between Europe and America, or Asia is also very different from Europe. I mean, it's difficult to know just now because, to be honest, in the last weeks we haven't been in touch so much with investors. I mean, there are different reactions, but they could have. I mean, the first, I think at the moment, I think most of them are waiting and seeing how long it's going to take and what's going to be the impact for them and their portfolio, so the companies they invested in. Some could be interested to see how they can invest in startups that they could, of course, solve the problem of the COVID, or that is showing some new problem that could solve this kind of crisis. I think, of course, people will be very careful about how to invest in the future. So what the people need to understand is that investors make money through selling the portfolio, the companies they have in their portfolio. So they've invested in companies and then they get their money back and the margin and the surplus by selling in the exit strategy. Okay, so of course the question that we will have today is that how, what's going to be the value that they will be losing or winning, but it looks like it's more losing at the moment with their portfolio when they want to go to the exit. And then for them as well, if it means that the exits will be postponed, for example, to 3 months, 6 months, 12 months. I mean, for example, I've got one case at the moment of a company who wanted to invest in another one in Germany. And we've just heard 2 days ago that because of the COVID-19, they will postpone everything for 6 months, for example. Because they say we have to wait until we know exactly how the impact will be on the market. Of course, also there is a situation very unique at the moment, which is this closing of shops and everywhere in many countries, and this is something really unique. I mean, it's the first time that suddenly we can't really sell many products, which is obviously a problem, I mean, especially in the fashion area. So this is something unique, and I think people don't really understand the impact that it has. How long will it stay like that? Will it start to reopen, and when? And what's going to be the behavior of the customer, of the consumer after that? Are they going to rush in the shops and buy more than before? Or in fact, they're going to say, well, in fact, we don't need to buy so much. We haven't bought for the last month and it's fine. So, we want to buy less. Also, they will have less money, definitely, to buy. So there are lots of impact, but we don't know yet. But I think if I want to summarize that, I think, of course, it's a period of timing. I mean, it's going to delay many things from 3 to 6 months to maybe more. And also really about whether the investors will they lose a lot of money in the exit strategy or not so much. If they lose not so much, I think that's going to be fine. If they lose a lot of money, of course, this money will not be back in the investment cluster, basically. Is to wait, to take a bit of patience, to keep in touch with their potential investors, even if it's postponed, to keep in touch with them and to continue working, on the B2B part. I mean, the B2B part is still quite active. In fact, I noticed that many people, they work from home, but they continue because they have more time than before, in a way, because they don't have to travel, they don't go to conferences or markets, etc. So, in fact, people on B2B have more time, I would say. But of course, yes, deals, pilot projects, etc., will not be developed and decided now. That's for sure. So people need to be patient about that and prepare their pitch, prepare their business plan, develop their product, the technology side, for example, from marketing, to be ready for when it's going to be finished. Social media and all this digital communication should be pushed much more, but it's all about building community, I would say. When we go to conferences or exhibitions, it's really to get to know new people, to have new people interested and building the community. This is what you can do on social media, on digital media, but most of the time it's for people you already know or already in your social networks. But it's you can acquire them, and for example, you can work a lot by through advertising, etc., to acquire new people. So, but it's of course slower and more costly maybe than going to conferences, etc. But we have to work with that. But yes, it's really about building the community, building the interest about the product and your company, and will be very, very helpful for the investors after a while. And of course, it's important that people develop their project, even though at the moment the kind of interaction with direct customers is lower. But you have to still develop your project further. You cannot just stop.